Namaskar, I am Parsuram Shukla, Training Associate Economics, KVS JIT Bhubaneswar. Welcome to my economics class. Today, I am with you all with my 5th video lessons from Unit 2, Class 12, Macroeconomics. The chapter is Central Bank from the unit Money and Banking. I have already discussed 4 video lessons from this unit. If you have missed the video lessons, you may watch all the video lessons using the links given in the description box given below. So today I will be discussing chapter 5, Central Bank. The content to be covered: concept of central bank, functions of a central bank. The learning objectives: at the end of this video lesson, you will be able to state the meaning of central bank, explain various functions of a central bank. Meaning of central bank. Central bank is an apex body that controls, operates, regulates and directs the entire banking system and monetary structure of the country. It is known as the apex or the supreme body as it occupies the topmost position in the monetary and banking system of the country. All the financially developed countries have their own central bank. India's central bank is the Reserve Bank of India. Reserve Bank of India, or in short RBI, was established in 1st April 1935 under Reserve Bank of India Act passed in 1934. Central bank is known by different names in different countries. In India, it is Reserve Bank of India. In UK as Bank of England, and in USA it is known as Federal Reserve System. Functions of central bank in this flow chart, it is given for your understanding: currency authority, banker to the government, bankers, bank and supervisor, controller of money supply and credit, custodian of foreign exchange reserves. We will discuss one by one all the functions. Currency authority, bank of issue. Central bank has the sole authority for issue of currency in the country. In India, Reserve Bank of India has the sole right of issuing paper currency notes except 1 rupee notes and coins which are issued by Ministry of Finance. The 1 rupee note bears the signature of Finance Secretary, while other currency notes bear the signature of Governor of Reserve Bank of India. All the currency issued by the central bank is its monetary liability. That is, central bank is obliged to back the currency with assets of equal value to enhance the public confidence in paper currency. Assets usually consist of gold coins, gold bullions, foreign securities and domestic government's local currency securities. Advantages of sole authority of note issue with Reserve Bank of India. It leads to uniformity in note circulation. It gives the central bank power to influence money supply because currency with public is a part of money supply. It enables the government to have supervision and control over the central bank with respect to issue of notes. It ensures public faith in the currency system. It helps in stabilization of internal and external value of currency. Note: central government is also authorized to borrow money from the central bank. When government incurs a deficit in its budget, it borrows from central bank by selling its treasury bills. When central bank acquires these securities, it issues new currency. This is known as monetizing the government's debt or deficit financing. Banker to the government. The Reserve Bank of India acts as a banker, agent and a financial advisor to the central government and all the state governments. As a banker, it carries out all banking business of the government. It maintains a current account for keeping their cash balances. It accepts receipts and makes payments for the government and carries out exchange, remittance and other banking operations. It also gives loans and advances to the government for temporary periods. The government borrows money by selling treasury bills to the central bank. As an agent, the central bank also has the responsibility of managing the public debt. As a financial advisor, the central bank advises the government from time to time on economic, financial and monetary matters. Bankers, bank and supervisor. Being the apex bank, the central bank, that is RBI in our country, acts as the banker to the other banks. In this sense, it bears the same relationship with commercial banks as the latter maintains with the general public. That is, the commercial banks maintains with the general public. As the banker to the banks, the central bank functions in 3 capacities: custodian of cash reserves. Commercial banks are required to keep a certain proportion of their deposits known as cash reserve ratio or CRR with the central bank. Lender of the last resort. When commercial banks fail to meet their financial requirements from other sources, that is in case of financial emergency, they approach the central bank to give loans and advances as lender of the last resort. Central bank assists these banks through discounting of approved securities and bills of exchange. Clearing house. As central bank holds the cash reserves of all the commercial banks, it becomes easier and more convenient for it to act as their clearing house. All commercial banks have their accounts with the central bank. Therefore, the central bank can easily settle claims of various commercial banks against each other by making debit and credit entries in their accounts. As a supervisor, central bank regulates and controls the commercial banks. The regulation of banks may be related to their licensing, branch expansion, liquidity of assets, management, merging, winding up, etc. The control is exercised by periodic inspection of banks and the returns filed by them. Controller of money supply and credit. This is a very vital function of the central bank. The Reserve Bank of India, RBI, is empowered to regulate the money supply in the economy through its monetary policy. It is policy adopted by the central bank, that is the monetary policy adopted by the central bank of an economy in the direction of credit control or money supply. As RBI has the sole monopoly in currency issue, it can control credit and supply of money. For this, RBI makes use of following instruments of monetary policy: repo or repurchase rate, bank rate or discount rate, open market operations, legal reserve requirements, that is variable reserve ratio method. Under this, cash reserve ratio, CRR, statutory liquidity ratio, SLR, and the fifth one is margin requirements. These are the monetary policy adopted by the Reserve Bank of India in our country. Repo or repurchase rate. Repo rate is the rate at which the central bank of a country, RBI in case of India, lends money to commercial banks to meet their short-term needs. The central bank advances loans against approved securities or eligible bills of exchange. An increase in repo rate increases the cost of borrowings from the central bank. It forces the commercial banks to increase their lending rates, which discourages borrowers from taking loans. It reduces the ability of commercial banks to create credit. A decrease in the repo rate will have the opposite effect. Bank rate or discount rate. Bank rate is the rate at which the central bank, RBI in case of India, lends money to commercial banks to meet their long-term needs. RBI has been actively using bank rate to control credit. Bank rate has the same effect as that of repo rate, that is, an increase in bank rate increases the cost of borrowings from the central bank, which leads to increase in lending rates by commercial banks. It discourages borrowers from taking loans, which reduces the ability of commercial banks to create credit. Repo rate versus bank rate. Repo rate and bank rate are almost similar except the following difference. Repo rate is applicable to short-term lending by the central bank and is governed by the short-term interest rate. On the other hand, bank rate is applicable to long-term lending by the central bank and is governed by the long-term interest rate. Reverse repo rate or RRR. This is exact opposite of repo rate. When the commercial banks have surplus funds, they can deposit the same with the central bank and earn interest. The rate of interest paid by the central bank on such deposits is called reverse repo rate. So it is the rate of interest at which the central bank, that is Reserve Bank of India, accepts deposit from the commercial banks. When the reverse repo rate is raised, it encourages the commercial banks to deposit their funds with the central bank. This has the negative effect on the lending capacity of the commercial banks. Lowering reserve repo rate has the opposite effect, which raises demand for borrowings from the commercial banks. Open market operations, OMO. It refers to buying and selling of government securities by the central bank from the public and commercial banks and to the public and commercial banks. RBI is authorized to sell or purchase treasury bills and government securities. It does not matter whether the securities are bought or sold to the public or banks, because ultimately the amounts will be deposited in or transferred from some bank. Sale of securities by central bank reduces the reserves of commercial banks. It adversely affects the bank's ability to create credit and therefore decrease the money supply in the economy. Purchase of securities by central bank increases the reserves and raises the bank's ability to give credit. Conditions necessary for success of open market operations. There should exist a well-developed and organized security market for the success of open market operations. The reserves of commercial banks should be affected with the sale and purchase of securities. The central bank should hold adequate securities to influence money supply in the economy. There should not be frequent fluctuations in the value of government securities. Legal reserve requirements or variable reserve ratio method. According to legal reserve requirements, LRR, commercial banks are obliged to maintain reserves. It is a very quick and direct method for controlling the credit creating power of commercial banks. Commercial banks are required to maintain reserves on two accounts, that is cash reserve ratio CRR and statutory liquidity ratio SLR. So first one is cash reserve ratio. It refers to minimum percentage of net demand and time liabilities to be kept by commercial banks with the central bank. A change in CRR affects the ability of commercial banks to create the credit. For instance, an increase in CRR reduces the excess reserves of commercial banks and limits their credit creating power. Statutory liquidity ratio. It refers to minimum percentage of net demand and time liabilities which commercial banks are required to maintain with themselves. SLR is maintained in the form of designated liquid assets such as excess reserves, unencumbered, government and other approved securities or current account balances with other banks. Change in SLR affects the freedom of banks to sell government securities or borrow against them from the central bank. An increase in SLR reduces the ability of banks to give credit and vice versa. Margin requirements. Margin is the difference between the amount of loan and market value of the security offered by the borrower against the loan. If the margin fixed by the central bank is 40%, then commercial banks are allowed to give a loan only up to 60% of the value of security. By changing the margin requirements, the Reserve Bank can alter the amount of loans made against securities by the banks. An increase in margin reduces the borrowing capacity and money supply. A fall in margin encourages the people to borrow more. RBI may prescribe different margins for different type of borrowers against the security of the same commodity. Margin is necessary because if a bank gives a loan equal to the full value of security, then bank will suffer a loss in case of fall in price of security. Other instruments of credit control. Moral suasion. This is a combination of persuasion and pressure that central bank applies on other banks in order to get them act in a manner in line with its policy. Moral suasion is exercised through discussions, letters, speeches and hints to banks. The Reserve Bank frequently announces its policy position and urges the banks to cooperate in implementing its credit policies. Moral suasion can be used for both quantitative as well as qualitative credit control. Generally, central bank succeeds in convincing the banks as it acts as their lender of last resort. However, no punitive action is taken in case they do not follow the advice or request. Selective credit controls. Under selective credit controls, the Reserve Bank of India gives directions to other banks to give or not to give credit for certain purposes to particular sectors. This method can be applied in both positive and negative manner. In positive manner, it means using measures to channelize credit to priority sectors. The priority sector includes small-scale industry, agriculture, exports, etc. In negative manner, it means using measures to restrict flow of credit to particular sectors. Credit control instruments of Reserve Bank of India, quantitative versus qualitative instruments. The central bank, Reserve Bank of India in our country, controls credit through the various methods which are also categorized as quantitative and qualitative methods. Quantitative methods include repo rate policy, bank rate policy, reverse repo rate policy, open market operations, varying reserve requirements. Qualitative methods include margin requirements, moral suasion, selective credit controls. Quantitative instruments are general in nature and it affects all sectors making use of bank credit. However, qualitative instruments are specific in nature, that is, they affect the flow of credit for a particular use. Quantitative controls are designed to regulate the total volume of credit, whereas qualitative controls are designed to regulate the direction of credit. Quantitative methods are also known as traditional methods of control, and qualitative methods are also known as selective methods of control. Custodian of foreign exchange. This is the fifth function of the Reserve Bank of India or the central bank of the country. Custodian of foreign exchange reserves. The central bank also acts as the custodian of the country's stock of gold and reserves of foreign exchange. This function enables the central bank to exercise a reasonable control on foreign exchange. According to regulations of foreign exchange, all foreign exchange transactions must routed through Reserve Bank of India in our country. Centralization of foreign exchange. Centralization of foreign exchange transactions with the Reserve Bank serves two objectives. It helps the bank in stabilizing the external value of currency. It helps in pursuing a coordinated policy towards the balance of payment situation of the country. Let us have a sample test for this lesson. See how you have understood and what are the things you have remembered correctly and what are the things you have not remembered correctly. So please have a check. So state whether the following statements are true or false with reasons. So you can read out this. RBI acts as the bankers to central government and commercial banks act as bankers to the state government. To increase the money supply in the economy, central bank reduces the margin requirements. These are the four statements. You have to say which one is true or which one is false with reasons. Repo rate is fixed by the central bank, whereas reverse repo rate is fixed by the commercial banks. Cash reserve ratio and statutory liquidity ratio are fixed by the commercial banks themselves. Fill in the blanks. Dash instruments of monetary policy affect the volume of money supply in the economy. Repo rate or dash rate is the rate at which RBI lends money to commercial banks to meet their short-term needs. Dash refers to buying and selling of government securities by the central bank from or to the public and commercial banks. Bank rate is also known as dash. 1 rupee note and all coins are issued by the dash. The central bank acts as dash to both central and state government. So let us check your answer which you have noted in your memory or you have noted down in the copy. Let us see the answer. The answers are marked in the reading. You check the first statement. The answer is false and the reason is RBI acts as the banker to central government as well as the state governments. The second statement, answer is true. The reason is fall in margin requirements enhance the borrowing capacity of public which raises the money supply in the economy. Repo rate is fixed by the central bank, whereas reverse repo rate is fixed by the commercial bank. So the answer is false. The reason is both repo rate and reverse repo rate are fixed by the central bank. The fourth statement, the answer is false and the reason is they are fixed by the central bank. Fill in the blanks. The first fill in the blank here is quantitative, that is quantitative instruments of monetary policy affect the volume of money supply in the economy. Repo rate or repurchase rate. This is the answer here. The third one, open market operations, refers to buying and selling of government securities by the central bank from or to the public and commercial banks. So the answer here is discount rate. Bank rate is also known as discount rate. 1 rupee note and all coins are issued by the Ministry of Finance. The central bank acts as banker to both central and state government. I hope you have checked your memory and understanding after seeing the answer. Assignment for you. What is central bank? What do you mean by bank of issue? Define bank rate. What is the meaning of open market operations? What is meant by margin requirements? State the main functions of a central bank. Explain central bank's function as currency authority. How do changes in bank rate affect money supply in an economy? Explain. So as usual, I have given the questions of 1 mark, 3 marks, 4 marks and 6 marks. These are the pattern in which the questions are asked in the board examination. Please give your feedback to my email ID parsuram.shukla@gmail.com. My WhatsApp number 9938649454. I hope you are benefited by this educational videos prepared by me. So kindly like, share and subscribe so that I may be encouraged to create more videos for all of you so that next videos also reach you immediately. Thank you for watching my video. Wish you all a good luck for the board examination. Wish you happy new year and see you next in my next video. Thank you.